Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative, here with the last week in mortgage today, our weekly look at all the latest happenings in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, the ever popular and always in at the last moment, as you see him still not here, Kevin Peranio, the Chief Lending Officer from Paramount Residential Mortgage Group. He did just email me and say he'll be right on. And so we'll give him a second just to go ahead and get logged on. And while we're waiting for Kevin, I'll go ahead and just kind of get started with some of the things going on in the news. And I see Rob Chrisman is on. Why don't we, can we activate Rob's? And there's KP. Look at that. KP. How's it going?
Am I okay? Am I good? I just did the summer shuffle and got all the kids out the door.
Looking good. I like that background. Some, unique art, and it looks like all sorts of interesting bottled spirits.
I'm just keeping it real,
Well, thanks once again for joining us here on the last week in mortgage today. Always appreciate your insight and perspective on the industry. And let's go ahead and get right into it. I'll start out just by reminding everyone, clearly strive for interactivity. So any questions, comments, anything that you have for Kevin or I or Rob Chrisman. Rob, you are unmuted. So we have Rob as well in here for the conversation. Please feel free to voice it aloud or put it in the chat. We'll go ahead and incorporate it into the show. So KP, I'm going to start with an interesting news headline that I was reading this morning. And the Mortgage Bankers Association, they recently, put some formal communication out there to all the different federal agencies and regulatory bodies regarding artificial intelligence. This is going to be a very interesting dilemma for our industry and the regulatory components of it. In a nutshell, what is happening is as AI continues to evolve in the mortgage industry, one area where it's evolving most prevalently is in the decisioning of loans. And, MBA's point, a valid one, is that if used properly, artificial intelligence, when used in the loan decisioning process, can consider far more data for people that are credit worthy, but not with traditional credit than conventional underwriting models. And that the benefits of AI can lead to a more inclusive lending climate. At the same time, it's just different. We've had humans decisioning loans in the past, and that's easier to regulate, obviously. Your thoughts on this issue and, just how you see it maybe playing out in the short and the not so short term?
Well, I know that, the thought and discussion topic of AI having biases inside of it has been something it's been talked about, throughout multiple industries, not just our industries, when it comes to, just the proliferation of artificial intelligence, of machine learning, of these, machine learning is more rules-based, whereas AI, true AI by its definition, it means that the technology is actually learning. And so it teaches itself as it gathers more data. So I don't know how much true AI is in our industry, and that's probably a discussion point that people could make on a technical level. Like, yeah, you're talking about AI, but we don't really have AI. We have machine learning, which is actually easier to manage because then you can manage your rules. We know the administration is trying to create more equitable housing opportunities. So, and obviously, I know the Mortgage Collaborative, PRMG, everybody on this call probably overwhelmingly supports that. I mean, what business owner doesn't want more business? So, it's interesting because, there are rules that are out there. I'll give you an example. I read an article this morning and it made me kind of think about something, and now you just kind of put them together. There was a survey done by the National Association of Realtors, and it said that sellers are less likely to accept offers for FHA and VA borrowers. And in the survey, it said because the home inspection guidelines are more strict, the appraisals, their appraisal staff, they're more strict, more specifically VA, even though, VAs, they're just protecting the borrower. So you've got some rules that are already in place by the government that, if instituted into machine learning or AI, would automatically rule out some programs in many instances that are the tip of the spear for equitable housing. So I think, obviously there's no quick solution here, but I think the government's going to have to look inward as well, because some of the rules that they've created are creating some of these biases in the market. We can control what we can control. And but again, AI and machine learning, these are rules-based technologies. So it'll be really interesting to see how this debate goes. At the end of the day, I think we're all on the same page with the government, the NBA, TMC, PRMG, everybody on this call, the government. We just want to put more people in houses, especially if they're deserving. And I think ultimately, as long as we have open dialogue, we don't have a gotcha environment with enforcement and regulators. You used AIQ inside Encompass and it didn't give the right decision, we're going to find you millions of dollars. That's not the kind of environment that actually helps put people in houses. That's just not what we're looking for, hopefully. So I'm cautiously optimistic that we're going to have enough dialogue between independent mortgage bankers and TMC, MBA, and all the different groups with our government and the different agencies to try and tackle this issue.
Such a fascinating confluence of events happening right now as it just relates to housing and housing finance. We talked about emerging technology. We have a CFPB that's going to be under new leadership that's going to have much more clear and direct initiatives that they're going to be pursuing. And now the Biden administration, which, really has spoken to housing a lot, more so than any presidential administration that I can remember in a long time, just different housing initiatives and things that they want to pursue. Of course, until a few weeks ago, there was, just sort of this FHFA Mark Calabria roadblock. Now that's been removed. And what that has done is opened up a dialogue amongst politicians, amongst people like me and you and others in our industry about the future of Fannie and Freddie. How will the Biden administration and the new FHFA director that they're likely to propose and put out there soon would be the thinking, use Fannie and Freddie to help achieve some of the goals that they want to see with fair housing and home ownership. Obviously the left is, proposing some, not radical, but things we haven't seen here in the industry, just if it's the delivery fee structure or the amount of risk that Fannie and Freddie are able to take on. And then of course, those on the right, pointing back to the meltdown of 07 and 08 and the taxpayer liability to all that. Would be curious just to get your perspective on how you see all this kind of playing out and where you see Fannie and Freddie, just the short-term direction of those two organizations.
Well, it can't get much more radical than the last 14 months when it comes to change. So, adverse market fee overnight, and the caps for second home and non-owner occupied being implemented basically overnight. For some of us on this call, it was pretty brutal the way it was implemented. And look, there's a serious brain drain at Fannie and Freddie. There are people there that were, upset with the way the FHFA was heavy-handed in the way they, implemented guidelines and change, and they left. So we're definitely in a rebuilding phase here. I do like the fact that the Biden administration is taking an active role in expanding housing. What business owner on here doesn't want to do more loans, especially when the pie is shrinking? So, we're all out there in the communities doing the work. And so I definitely am excited to see some of these changes coming. It's very political. It's been politicized. In fact, the reality is the Supreme Court, for all intents and purposes, affirmed that it is politicized, that this is really the FHFA position is at the behest of the president, whoever that is, whichever party that is, and they cannot have more power than the president of the United States of America, and that goes to the CFPB as well. So they're going to use these agencies to implement their housing policy, and they have been active and very vocal on what they want to implement. And I think, again, most of us on this call would say that, if it's going to expand housing, that's a good thing. That's a good thing for all of us. Again, I go back to the gotcha environment of the early days of the CFPB. When it was, we're not going to tell you what we need in our guidelines, but we're going to bust you for it later and fine you millions. What does that solve? I mean, does that help? Does that help people in houses? I don't think so. So, I remember being at a NAM event one year in Vegas, and I raised my hand to some deputy director of CFPB. I go, hey, can you just tell us what you want us to do? We'll all do it. I promise you, everybody in the TMC, we'll all do whatever it is. Just tell us what to do. No one wants to get fined. We all want to put more people in houses. Just tell us exactly what you mean with your guidelines, and we will help implement it. We can be wielded as a tool for this administration in many ways, just like the CFPB and the FHFA. And so if they truly want to do their mission and complete it, we are the ones in the communities. And so what I would just add, one more thing there is that, there's some politicization of the way things are done. I think, look, President Biden was a senator for many years. So, I've already seen the way, he's going to disappoint some people on the far left that got him elected. He's not an ideologue. He is someone that's there to try and make things happen because he doesn't want his party to lose power in the midterms. More than 3/5 of the swing states, the surveys have already been coming back. They're not in favor of higher taxes. They're not in favor of some of the far left agenda. And so I think he's going to, in many different areas, including housing, he's going to cut some deals. And what's a great bargaining chip? Hey, you know what? Independent mortgage bankers, I need you to implement this first-time home buyer fee. I need you to implement these policies on fair housing. In return, I'll remove, maybe the non-occupied cap or the adverse market fee or the second home cap. I could see some things coming out of that where it's a little bit of give and take. There's just, maybe I'm being optimistic, but I don't believe the headlines that I read all the time in housing. I believe in what I see with my own eyes, and I'm positively, cautiously optimistic about where things are going in these 4 years.
I share that same cautious optimism. I think you could see some things done that make sense with some push and some pull on both sides. And it'll be interesting to see how it all plays out. So this is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by PRMG Chief Lending Officer Kevin Peranio, and Kevin, Rob Lord Varys Krisman and his spies that he has deployed throughout the industry. And Rob, his audio is open if you'd like to chime in here. But it was in his newsletter, I think last week or late the week before, was citing one of the research and analyst firms that laying out some things that we could see with Fannie Freddie under the new director, under the Biden administration. First-time homebuyer tax credit was mentioned. Removing the non-owner caps and the 2 out of 3 rule and some of the other stuff that was in the PSPA. Further enhancements to the refi programs that the agencies rolled out, and also a change in the structure of the delivery fee setup, which I thought was very interesting. The one now that, if you're 698 FICO score and 90% LTV, it's whatever it is. But Rob, any further developments, anything you've heard about things that could be coming from the agencies? And I know we don't have a director yet, but I'm just looking for speculation at this point.
Can you hear me okay?
We can hear you.
I want to know what is in the vials of behind Kevin, where he's keeping it real. Having just come back from New Orleans, I'm very curious. But Rich, I'm going to let you down here a little bit. I haven't heard anything. I think that Sandra is getting settled into her job. I'm sure she's receiving a lot of input from industry sources and but also from consumer advocacy groups and regulators and so forth and so on. So I don't think that she's going to be prone to making any harsh moves, quick moves. I think she's going to hopefully think it out, figure it out, and make some prudent decisions. So, we kind of stand by and wait and hope for the best.
Yeah, you went to New Orleans. You went to New Orleans, so I know you had a few vials. Let's see here. I got something. I get a little drink kit from Napa Valley Distillery once a quarter. And they sent me some rum drinks for the summer. So there you go. I'll share one with you next time I see you, Rob.
There you go. Thank you. I appreciate it. Kevin, I guess I'll see you early next week in San Diego, right?
Yeah, I'm definitely heading out there. We have our senior management meeting on Monday, and then my plan is to be there for the Monday evening thing. So look forward to seeing you.
Absolutely.
Excellent. Moving on to some other things in the news, pending home sales in May, highest level since 2005. I think that's noteworthy because it beat analyst expectations by a large amount. We had seen the pending home sales number decline the last few months as we get into what is normally the heart of spring buying season. At the same time, some of the June, like MBA weekly application numbers, either stagnant or down a little bit. KP, your sense of just the general volume climate right now as we start to get into the heart of summer here?
Well, we have a demographic wave that's hitting our country. It's been set up for quite some time. And, the first-time home buyer, 32, 33, I don't know, depending on which report you read, people turning those ages gets larger and larger each year. For like 9 years in a row. I think we have 5 more ahead of us where that wave is coming. So people, household formation, they want to have homes. I mean, that's the demand wave. It's not just low interest rates. Obviously that helps on the margin, but the demographic wave is the bigger piece. And so I'm not a surfer, but here in Newport Beach at the end of the peninsula, they have this wave called the wedge, and it's basically where like 2 sets of energy come together and create this huge double up. It's insane, and it's only like a foot deep, so it's crazy. These guys out there surfing, and body surfing. So the other wave that's hitting is obviously a shortage of supply, and I think last decade we're 5 million units short, and the reason why is because builders got crushed in 08 and 09, and they just said, you know what, we're not going to build. We're not going to just build endlessly and have spec homes out there and expect to sell it. They literally get under contract and they start building. So I will say that shortage of supply is a big deal. Those 2 waves coming together. Every market's different, but we're just talking macro here. The thing is that 15% home appreciation on our last read. I mean, that's insane. So when people feel comfortable about maybe letting someone in their house. I mean, everyone has their price, right? I mean, if someone gave you a certain amount of money, you would sell no matter what. I don't know what that is. I mean, that's maybe an over exaggeration, but those numbers are getting closer and closer for many people. And the other wave, I guess, is a little smaller wave, but the work from anywhere, work from home, you can literally work from anywhere. So maybe you want to sell in your neighborhood, you're tired of whatever this traffic is, and you want to go live somewhere more remote or near a lake or whatever, downsize. All these waves are hitting. Are going to help us. And I will say that will also help the forbearance issue. You got 2 million borrowers in forbearance, and you've got the pandemic on assistance ending at the end of September for, federally, and many states have already cut that off. You've got a lot of waves coming together where people are like, okay, I got to get back to work. I got to sell my house. I got to start making my mortgage payment again. I got to find a home because I'm forming a family. There's no housing here in my neighborhood. I got to go look somewhere else, and rates are still historically low. So I'm very bullish. I'm not trying to be Pollyanna and say that there's no issues that we have to face, but I think after the last 15 months, what we face as a nation, as a world, I don't think there's anything we can't overcome that's a challenge in housing.
And it does. The numbers seem to bear out what you're saying there. Another report that came out late last week from Realtor.com, just home listings in general up 10.9%. in June compared to May. That's not an
That's crazy.
insignificant number. 11% more listings in June versus May. The month's actually one day shorter. So it seems and feels like the demand side of it, I think, is still there and is still very high. But it feels like there's some relief coming on the supply side, maybe not to normalize things fully, but at least on a road to something more normal, it seems like.
That report, that to me is the most shocking stat I've heard all month. Of course, it's early in July, but that's pretty crazy. I mean, to think that listings increased that much, that's a big deal. But again, everyone has their price, and you're in the middle of summer. There's a little bit of FOMO. People see all these houses around them. I mean, you have access to everything on all these online systems. You can see what your next door neighbor's house went for, what the person down the street bought, and you sit there and you talk about it at night, with your spouse or your significant other or your family, or maybe you're single and you're like, I have no kids, I'm single. I mean, single women made up a huge demographic of first-time home buyers the last couple of years. They're like, I could work anywhere, and they're seeing all this information. So yeah, there's probably a little bit of FOMO. Typically the purchase season kind of lasts through July and then starts to taper, but maybe there's some pent-up selling demand because of because of COVID and all the quarantine and lockdown. You don't want a bunch of strangers walking through your house if you think you're going to get a bat virus and die. And now that you're potentially vaccinated, or we reach herd immunity in your community or whatever, you're like, okay, now's a good time to sell. Good thing I waited, because I just made an extra 100 grand. So I think there's just a lot of factors all coming together there.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, this week joined by PRMG Chief Lending Officer Kevin Peranio. I've got about 5 or 6 minutes left with Kevin. Another item from Rob Krisman's newsletter this morning just really touched on the CFPB putting out their regulatory agenda for the next 12 months, under the guise of just being transparent. Some of the things that were on there: an assessment of the rule implementing HMDA, rulemaking addressing the expiration of the LIBOR index, consumer access to financial data in electronic form, interagency rulemaking to develop regulations for QC standards for automated valuation models. Anything in there that was of note to you, Kevin, and Rob, of course, we have on the line as well, if he's got any further context on any of the items I just mentioned from his newsletter this morning.
Rob, you get to go first, buddy. I talk too much.
Kevin, you don't talk too much. Actually, Rich, to tell you the truth, I haven't looked into it any more than what I put out there today. So maybe Kevin's heard something.
Well, my feelings about the CFPB is, they've made some personnel moves, and they've really shored up. As Rob mentioned earlier about Sandra Thompson, she's acting director, but I think, excuse me, that's FHFA, but the CFPB has made some moves as well, like taking David Uegio and putting him in charge of enforcement, and then having, Rohit Chopra's, confirmation, getting him into the head and run that. And he came over from the, I believe it's the FTC. So, it's, again, I'm cautiously optimistic that, if you're doing right by the consumer, then you don't really have anything to worry about. I don't think we're going to have as much of a gotcha environment as we did under Richard Cordray, but they are certainly going to be looking for people that are not doing right by the consumer. Fortunately for us, the big focus is on payday loans and debt collectors. But if you're a mortgage servicer, which we are, and I know a lot of independent mortgage bankers on here got forced into doing that, last year when the aggregators just wouldn't pay for good loans, you make sure you have your systems down. Make sure you're giving borrowers every chance they can get, to keep that house and not go through foreclosure, which, I think is interesting. The CFPB put out some guidance last week on how to do workouts and foreclosures for those affected by COVID. So even though the guidelines are extended, I believe, through the end of this month, So there's like a month gap there, basically. I think, you can't, the moratorium is through this month, but then you can't really start foreclosing on someone until after August. It's kind of a weird little gap there. So you got people in a holding pattern, but so what? We've had them in a holding pattern, in forbearance. It's really what it is. At the end of the day, I don't think, as long as you're staffing up your servicing team or you're managing your sub-servicer that's doing your work for you, which that's your responsibility as the master servicer ultimately, as long as you're making sure you're keeping the complaints at a minimum, the workouts have the borrower's best interest in mind, and the last thing you do is foreclose, you should be okay in the eyes of the CFPB. And I think, other than just going through the massive amount of 2 million borrowers in forbearance and working through it, ultimately every one of them can just flip their house for sale. Just sell your house, pay off your debt, go somewhere else. We don't have to do anything bad here. Let's just help you sell your home. We have a housing shortage, and you might actually walk away with money, if you can't find a job. I did like the fact that the Ginnie Mae securitization for a 40-year mortgage was put out as well last week. And that almost specifically is for modifications. So if you have an FHA, VA, USDA borrower that you're trying to work out of forbearance, you could put them on a loan mod for a 40-year amortization, and now you can securitize it, through Ginnie Mae, which is fantastic. Which by the way, I hope the Biden administration gets rid of that $1.5 billion cash window cap to the GSEs. That would be nice as well for all of us independent mortgage bankers. Or else we'll just have to hold our cash a little longer, hold our securities a little longer. But those are the things we're looking at as a servicer, and what the CFPB is focused on right now. And I think that's what would affect probably most of us on the call first and foremost.
Yeah, Rich, you've heard me before use this example, but Kevin's tootling down I-5 in his Corinthian leather interior Range Rover, and he's going the speed limit, and his registration is up to date, and he's got 2 or 3 highway patrolmen driving next to him. He doesn't care. He's going the speed limit. His registration is up to date. They're not going to pull him over. And you've heard me say this before. A lot of companies are in much better shape than they were 10 or 15 years ago. They're doing the right things. They know how to handle consumer complaints. Consumer complaints are way down. They just have a different business model. It's more compliance heavy. It's more bent with, or I should say, they have an eye on the regulations, and it's a different industry than it was back then when Richard Cordray took over. And so I think so many companies are doing the right thing already, that we don't have as much to worry about. That's not to say the CFPB won't be taking a look, especially with regard to the pandemic and who's making their payments and who's not. But I found it interesting in a cynical kind of way that the CFPB is making all kinds of news, but yet when Juneteenth came along, they were oddly quiet with regard to some of the regulatory guidance that the industry was in need of. So, we'll see what happens, but I think the industry is doing the right thing now and handling consumer complaints the right way. And to Kevin's point, there's so much equity out there. Let these people sell their houses and go somewhere else and sell them to some 30 or 35-year-old family that wants a good home, and away we go. The problem will fix itself.
Well said.
Rob, you sound like somebody that got likely several hundred Juneteenth emails from your reader base. So I can only imagine that. Yeah, it would seem to reason a presidential administration that has really been very openly and outwardly focused on creating home ownership opportunities for as many Americans as possible would not also have a regulatory body in the CFPB that lenders are terrified of. And it seemed, and as you mentioned, Rob, I mean, the last time we had a presidential, Democratic presidential administration, so many things were different. The compliance side of the industry has evolved so much. I mean, delinquencies, if you omit, pandemic related forbearances, are way down. The mortgage meltdown is now much more in the rear view mirror. Loans in general have performed well, and lenders by all measurements have done the right things and operated in, very safe and secure ways. So it feels like we're going to be going into a pretty good era for mortgage lending in the housing industry. The one where I think you have the best balance of common sense, regulation, and ability to make sense loans. But we'll see what happens. So excellent. Well, KP, thank you as always. Always really enjoy getting your perspective on the industry as somebody we regularly tap on here at TMC to help lead discussions, and looking forward to seeing you soon in person here. But thank you very much for joining us.
We'll see you at Peranio.
Oh, I can't wait. And Rob, as always, appreciate your feedback and jumping in and keeping us all entertained on a daily basis with your daily newsletter. And of course, Rob and I do the rundown, going to a weekly format on Friday afternoons coming up here starting in a couple of weeks. So Rob, you ready for the weekly format?
I'm ready. And I was going to say, Rich, that when the apocalypse hits, I'm going to Kevin's wine cellar.
It's about the only place you haven't started showed up broadcasting from. The Fredo Corleone Lake, the bar in Alaska. It's somewhere. It's become a big part of that show. So
trying to stay one step ahead of the parole officer, Rich.
And as always, to our attendees, thanks for taking 30 minutes out with us. We are here, same place, same time, every week, every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. And until next Tuesday, have a great week, everyone. Take care.
Thank you.